guys, JC Parets here of allstarcharts.com, and welcome to the show. So when we first started doing this last week to kick off the new year, by the way, shout out StockCharts TV for the invite to come on the program. They asked me, like, JC, what do you want your show to be like? And I was like, why don't we kind of make at least some educational point, kind of cover something that, I think really helps me, something that maybe I learned the hard way. Sometimes I learned things the easy way from my predecessors and fellow colleagues and things like that. So we can touch on something educational, something of value, maybe a new tool or something like that. And then I figured we talk about the markets, right? That's what we're here for. We're looking at this stuff. We're having conversations internally. In fact, we had our weekly team meeting this morning where we're talking about the market. So I got all sorts of ideas flowing. And then we can take some questions. Ask JC. Anything you want. So I figured that's sort of the game plan. Last week seemed to have worked out pretty well. So let's just kick it right off. So today's lesson, what I want to talk about is the top-down approach. I want to show you exactly what I mean here. This is the top-down approach. And this is not anything that I really made up. It just, over time, it seems like common sense, almost, at least to us anyway, that this is probably a good idea to do. This is probably where things should start. And I'm going to preface with this so that we can get into some of the different universes that we have created that are more bottoms up, right? So this is top down. We do all of our top down analysis, and then we create a series of universes that are that bottoms up to supplement this work that we do. So we're going to get into that in a minute, but in order to really appreciate the value as to how important these bottoms-up universes are to our process to make sure we don't miss anything or make it really hard for us to miss anything, I think you first need to understand how important it is to first do the top-down work. So what does this mean? Well, first thing we're going to do, we're going to have a conversation about stocks. We need to look at stocks as an asset class. We need to be looking at stocks all over the world, right? So it's not just, what's happening in the Dow or the S&P 500, what's happening in the German DAX, Japanese Nikkei, emerging markets, Asia, Europe, Latin America. It's not just, the world doesn't revolve around the NASDAQ 100. In fact, if you look at charts around the world, they don't look like the NASDAQ 100. Maybe Taiwan, South Korea. I mean, there's some winners, obviously. Think about what countries I just mentioned. What types of companies and stocks are in those countries? The types of companies and stocks that are in the NASDAQ 100. So if you're going to find, Europe hasn't done anything for 20 years. It doesn't look like the NASDAQ 100 because you got a bunch of European banks in there, and the NASDAQ 100 has 0 banks. So it's important to understand what's in it, what's going on. All right, fine. So the top-down approach, international stock markets, every country around the world. If there's a stock exchange, it's going to be on our list. In some cases, there isn't, and we have to create our own, and it's this whole to-do. But the bottom line is we're going country by country. Are more of them going up or more of them going down? Are these countries' indexes resolving higher or are they resolving lower? And then the old question, well, JC, do we analyze these countries' indexes in local currency? Or do we analyze it priced in US dollars? In other words, do we look at the ETF that's priced in dollars, or do we analyze the index itself priced in local currencies in most cases? My answer is we do both, right? Let's look at both. And you're going to get very different information depending on how crazy their currencies are. Maybe something like Argentina, the dollar denominated versus the local currency denominations are going to be very different. For example, granted, that's an extreme example, but an example nonetheless that I think really makes that point. Look at Turkey with the lira. Turkey's breaking out in local currency. It looks completely different priced in US dollars, but also coming off of an interesting low. So, the point is when we're looking at these countries to use both. Okay, fine. So we're looking at the country stock markets. Before we get into the US stock markets, we also need to know what's going on in the other asset classes, what's going on in commodities, and not just oil and gas and gold and silver, but wheat, corn, soybeans, cocoa, cardamom futures, Malaysian palm oil futures. I mean, we're going across the board and really seeing what's going on in precious metals, what's going on in energy, what's going on in the ags. As a group, is there information there that we can generate to help us in the stock market? Usually there is. Pretty much always there is. Or always, maybe I should say. What's going on in the bond market? Interest rates all over the globe. What's going on? Are they going up? Are they going down? Are they going up simultaneously? Or some going up faster than others? What do the yield curves look like? And then, of course, we touched on the Forex markets, but, we really dive in. Probably the most common 60 crosses. So not just euro, yen, Aussie, CAD, pounds, but Nakisaki and all of the ones in between. And most importantly, the intermarket relationships among them all, how base metals and precious metals affects interest rates, different sectors in the United States. There's a lot of information there. So after we do all of that analysis, then we're going to dive in to the US stock market indexes. And again, not just the Dow and the S&P and the NASDAQ 100, but small caps, mid caps, micro caps, value line, New York Stock Exchange Composite, Wilshire 5000, the Dow Jones Composite Index, the S&P 1500, all of the indexes across the board, like some of the factor stuff, the momentum index, growth, value, all of those things, the relationships between them all, growth versus value. We're going to be looking at all of those indexes. And again, are they making new highs? Are they breaking out of bases? Are they rolling over? Are they putting in major tops? Are they in big ranges? Which ones are doing better than the others? We're comparing them as well, not just down the cap scale, but also, like, for example, the New York Stock Exchange Composite has a lot more international exposure. Over half of its largest 100 components are international companies, the New York Stock Exchange Composite. Hence, its underperformance over the years. So it's important to understand what we're analyzing exactly, right? The Qs don't have any financials in them. So that's important to know. Hence, their outperformance, right? So this is really, really good information. Fine. We're looking at them on a long-term basis and on a short-term basis. All of these things, not just the U.S. stock market indexes, but all the global indexes, all of those commodity markets, crude oil and soybeans and everything like that, all of the currencies and intermarket relationships as well. The long-term perspective, bigger picture, we're looking at charts that go back 10, 20, 30, 40 years in some cases, or 100 in some cases, right? The further back, the better. Good information. And then we break it down to 9 to 18 months out to really get that tactical perspective. So we get the structural perspective, longer term, tactical point of view, shorter term, and we're looking to make money this quarter. That's the goal. We're interested in the next weeks, next months. That's what we're looking at. I don't care what happened today, unless it was crazy dramatic, in which I do care, but chances are it was not. And I don't really care what happened today because one day doesn't make a trend. I also don't care what's going to happen next year. I'll worry about next year. I don't even know what I'm having for dinner tonight, yet alone what I'm going to be doing next year or what the stock market's going to be doing. I'll worry about that then. The next couple of weeks, next couple of months, that's the sweet spot. That's where we find the biggest advantage, right? That's the sweet spot. Shorter term than that, it's real tough. Longer term than that, it's real tough. Weeks and months, that's the sweet spot. Okay. And by the way, that's just me, right? Okay. So we talked about the global markets, the intermarket analysis. We got to the U.S. stock market indexes. Now we get to the sector level. Depending on who you ask, maybe there's 10, 11, 12. You'll get different answers. But basically, you know them all. Technology, financials, energy, utilities, healthcare, communications, right? You've got 11 or 12, REITs. So you got 11 or 12. Now, within each sector, and again, what are we doing? We're looking at the long term and the short term. Are they going up? Are they going down? Which ones are going up faster? Who are the leaders? Are the staples leading or are consumer discretionaries leading? Are financials participating or are they dragging down the market, right? Within the sectors, now you have different industry groups, right? So you're noticing this top down, this funnel, this deductive process where we're eliminating other possibilities, right? Because if the stock market's making new all-time highs and we want to, for whatever reason, want to be buying leadership, then we're not going to probably be buying the sectors that are making new relative lows, for example. So that's what we're analyzing. Now we're going to dive into the industry group. So within each sector, you have different industries, and they could be vastly different. So energy, for example, you have energy as a sector, and then within that, you've got the oil services. You've got the integrateds, the explorers and producers, refiners, solar stocks. You've got all sorts of different energy, wind, right? There's like new energy every day. I got all kinds of stuff, the natural gas stocks, all different areas within energy. What about financials? You got the broker dealers, you got the exchanges, you've got insurance stocks, you've got regional banks, capital markets, you've got all kinds of different types of companies in them. And what about all these mobile payment companies that are really tech? Are they financials? Are they not? Right? So it's important to understand there's all sorts of different kinds of industries. Think about healthcare, right? You've got medical devices, which are a bunch of robots doing surgery. It sounds more like tech than healthcare, which is probably why the charts of medical device stocks look like tech stocks and not like some of these other pharmaceuticals or whatever. But again, within healthcare, you've got medical devices, pharma, biotechnology, managed health. You've got all these different kinds of companies. So all of these sectors have industry groups within, then I think it's important to narrow it down there. And then ultimately, that's where we find the stocks. Because in our, let's just say for whatever reason, we want to buy Abbott Labs. 95% of the reason why we're buying Abbott Labs has nothing to do with the chart of Abbott Labs. It probably has to do with the fact that we like stocks, we like US stocks, we probably like large caps, we like healthcare, we like medical devices, and it just so happens that Abbott Labs offers the best risk versus reward opportunity to take advantage of our bullish thesis in medical equipment. Maybe Medtronic ran off too far, or maybe it's underperforming now, and for whatever reason, Abbott Labs is the best risk reward. But the truth is, most of the reason we're buying Abbott Labs has nothing to do with ABT. It was more to do with we're probably buying one of these medical devices. It's just this is the one we chose. So that's the top-down approach. I find it incredibly useful. I know a lot of my fellow colleagues, some of the best in the business, as far as I'm concerned, this is how they approach markets. I didn't make this up. Some people call it the all-star method. Like, that's bullshit. Like, that's just not true. We use this, but I didn't make it up. I learned it from people around me. And for me, this is the process that I think adds the most value. So I hope that makes sense to you. Now, what do we do to supplement all of that global macro intermarket cross-asset top-down approach? What do we do? Now we build a series of universes to supplement that work. This is more bottoms up, and we're going to get into that. All right. Let me get out of the way here. So when it comes to answering the question, hey, should we be buying stocks? Spending our time looking for stocks to buy, or should we be spending our time looking for stocks to sell? Right? How should we be allocating our time? When you talk about stocks, we want to look at what the alternatives are. What are the alternatives to owning stocks? I think gold and bonds are two pretty good ones, right? I don't want to hear this Bitcoin stuff, at least not yet. From a market capitalization standpoint, it doesn't even put a dent into real institutional money, but gold and bonds absolutely do, and I think it's a good indicator. You can have your theories about Bitcoin. I have mine, but from a global macro standpoint, real implications in the market, I'm just not convinced that Bitcoin is something we need to be concerned with. If you want to trade Bitcoin, buy it, short it, all that is great. Now, it's intermarket global implications. I'm going to put a lot more weight, or all of my weight for that matter, at least at this point, with gold and bonds. And I'm seeing both gold and bonds breaking down to new lows, right? Which makes perfect sense in an environment that stocks are doing very well and that are making new highs. Now, let's take a look at some of the sectors. These are some of the more defensive areas: utilities, consumer staples, of course, real estate. I'm seeing new lows on a relative basis. So the types of areas that should be underperforming in a strong market are, in fact, underperforming. Gold and bonds are making new relative lows, staples, new lows, utilities, new relative lows. This is what risk appetite looks like, folks. This is what it looks like. Aussie yen making new highs. Stocks breaking out to new highs relative to bonds. Stocks making new highs relative to staples. In other words, consumer staples making new lows, as we saw in the chart before. Gold making new lows, just like in the chart we saw before. In other words, stocks making new relative highs versus gold. This is what risk appetite looks like, folks. If you're a gloom and doomer and you think that the stock market should be going lower, and it's you can't justify buying stocks, and you think stocks are going down, remember that it doesn't matter what you think. It matters what the bond market thinks. It matters what investors in precious metals think, or lack thereof in this case. It matters what the Forex markets are pricing in, particularly Aussie yen is a great risk on, risk off indicator. Not to mention it looks exactly like all these other ones, in case you hadn't noticed that. So if you're Mr. Gloom and Doom and you think stocks are going lower, I think you really need to watch these crosses, right? We mentioned it last week on the show. You really want to watch these crosses. So bottom line is, do we want to be spending our time looking for stocks to buy, or should we be spending our time looking for stocks to sell? And I think through today is now Wednesday, the 13th of January, the weight of the evidence continues to suggest that we're doing the right thing. We've been doing this since April. It's been working. In April, we took a couple of shots on the short side. We got steamrolled and we stopped doing it. Because while we were getting steamrolled on those two shorts that we put on, I think one of them didn't even get triggered. We were so wrong. And the other one, we got stopped out right away. But at the same time, our long positions were exceeding expectations. That was the market giving us information. So what did we do? We bought more stocks and we stopped shorting them. That worked out really well. And what have we been waiting for since then to get more defensive? We've been waiting for some of these more defensive assets to catch a bid. And they haven't. Gold and bonds have been the two worst trades you could have possibly been in since the summer. Oh, everything has gone up except those things. And that is characteristic of an environment that investors are being rewarded for owning stocks versus shorting them. So what are we doing here? We are doing all of this top-down work, but there are names that maybe are small caps or mid caps or maybe large caps that don't get, smaller large caps that don't get much attention, and they just not coming up on our top-down work, right? Because they're not a large cap, they're not Abbott Labs, they're not Microsoft or Apple or some of the, Home Depot, some of these larger components of these sectors and the industry groups that we look at. So what is the Under the Hood report? It comes out every two weeks, comes out on Mondays. And this is a list of stocks that are showing an unusual increase in investor interest. Could be insider buying, unusual options activity, huge volume days, whatever it is, for whatever reason, social media mentions, for whatever reason, there are now more investors or more people interested in this name than they were before, all of a sudden, for whatever reason. Now, that doesn't necessarily mean that we want to just go out and buy these names. It doesn't mean that at all. All of this list is that it's like, hey, JC and team, there are just more people looking at this thing now than there were before. So maybe you should take a peek and see if it's worth your interest. And in most cases, I don't want to say most, in many cases, it's not. It's just like, hey, I wonder, fine, the CEO bought a bunch of stock. Great, it looks like crap. Fine, right? But at least we took a look, and that's really what it's for. So here are a couple of names that I like. This comes directly from the Under the Hood report. Here we're looking at Workiva, WK. And let me just move this over a little bit so you guys can get it. There you go. So this is a WK. I like it long if it's above 90. I love this major base, as you can see here. The more times that a level is tested, the higher the likelihood that it breaks out. For me, this is the breakout. We hit our first target of 90. We've been consolidating sideways. I think it's off to the races. The stock's above 90. I like it long with a target of 132. And by the way, if you want these slides, just email info@allstarcharts.com, password universe. Make sure you say the correct password. Otherwise, you're going to get some other presentation maybe that I gave in Malaysia or in India, and you're not going to be interested in that. So if you're interested in these slides, make sure you use the password universe, info@allstarcharts.com. All right, another name from the Under the Hood list. As you can see, there's a bunch of them. Another name that I like a lot is OLED, Universal Display Corp. This is a great example of a name that I've never heard of in my life. Maybe you guys have, and I'm the weird one that hasn't heard of it, but hasn't been on my radar. Never heard of this in my life. Universal Display Corp, OLED. I think they do something for Apple or something like that. Maybe I'm making that up. I don't know. It doesn't really matter to me. The point is, we had resistance in 2019, resistance again earlier last year, finally got back to the scene of the crime, broke out, retested, and now I think it's off to the races. So 230 is the level there. OLED above 230, I like it long with a target of 307. That coming directly from the Under the Hood report that comes out every other Monday. And then finally, SPS Commerce, SPSC, breaking out on a relative basis, well-defined risk-reward, 112, the level there. So if we're not above 112, leave it alone. But above 112, I like it long with a target of 164. And one of the things I like about these is how well the risk is defined. Because like OLED, for example, if we're below 930, there's no reason to touch it, right? Somebody else's problem. Above 230, I like it long with a target of 307. Same thing with Workiva, WK. If it's below 90, it's not our problem. Let it go to 0. I don't care, right? Somebody else's problem. Above 90, I like it long. I think it goes a lot higher. This is internally, this is our favorite report. I don't know if we're allowed to say that. I don't think you're not supposed to have like a favorite child. You're supposed to like love them equally. But we really can't help ourselves. Truth is, internally, the 2 to 100 club is just a sexy list. We say that this is the sexiest list of stocks that's ever been created. There has never been a sexier list. And what's going on here? We're looking for the next $100 billion companies. That's what we're doing. So we filtered out 13 different industry groups that we think can scale from 2 billion to 100 billion. So as soon as it graduates from small cap to mid cap, because under 2 billion is small cap, above 2 billion is large mid cap. So as soon as it graduates from small to mid, it comes on our radar. If it's within one of these sectors, it also has to be making new highs, because the stock's not going to go from 2 billion market cap to 100 billion by making new lows, right? That's just math. Some people kind of forget some a little of that common sense, but got to be making new highs, got to be in one of 13 industry groups. We don't care what country it's in. Usually it's in the United States, as you can imagine, but we find things in Israel and the Bahamas and London, things like that all the time. China, obviously. Look at Peloton. I like this name a lot. PTON. This has been a big winner. This is a $48 billion company, so this is not, so our sweet spot is between 2 billion and 35 billion. That's really the sweet spot that we're looking at. So this Peloton was part of the 2 to 100 club. It hasn't gotten to 100 billion yet. It's about halfway there. This used to be on our list. It's done very well, as you were all very well aware at this point. 150 is a new level. So, as Babe Ruth said, yesterday's home runs don't win today's ball games. So great. It's been a monster for us last year, but what does that have to do with now, JC? Nothing, right? Nothing. All that is irrelevant. Moving forward, if we're not above 150, can't own it. Got to leave it alone. But above 150, I like Peloton long, $48 billion bicycle that doesn't take you anywhere. What about Sonos, consumer electronics? I use my Sonos every day, not to get too fundamental on you. I like to be pride myself on my price behavior, but it's a dope product. What do you want me to tell you? I like it. Not that matters in our analysis. Sometimes I like knowing, because most of the time we're trading these stocks, I have no idea what they do, right? Some biotechnology saving the world. Great, save the world, but I have no idea. I don't know anything about it. At least this one, I'm going to turn on as soon as I'm done here. So what do we got? We got resistance at the IPO in 2018. We're finally back to the scene of the crime, just now breaking out. 23.5 is my level. If we're above 23.5, I like this one long with a target of 34. And finally, on the 2 to 100 club, here's Vicor, V-I-C-R. Am I saying that right? Vicor. Here's a great example of a stock I've never heard of. And I do this for a living, like every day of my life for years and years and decades now we're going on. And I have never heard of this company in my life. And that's why we do. That's why I wanted to preface with the top-down approach. Because if we just did the top-down approach and didn't supplement that work with these bottoms-up universes, we're going to miss all these things, like this Vicor Corp, this $4 billion electronics company. I have no idea what kind of electronics they do. I like the consolidation, though. I like the breakout above 88. It's above 88. I like it long with a target of 126. It's a little extended at this point. But maybe on weakness or something like that. I'm going to show you. We have I think we're at 5 different universes that we create. We actually got a couple more internally that we haven't released yet. We just released the minor leaguers, so maybe I'll save that for next week. But here, what we're looking at, this is the Young Aristocrats list. So I don't know if you guys know what an aristocrat is. So an aristocrat is a stock that has raised their dividends every single year for 25 consecutive years. That's what an aristocrat is. So what we're looking at, we're trying to stay ahead of the curve, obviously. So we're trying to buy the stocks that we think are going to be the future aristocrats. So rather than stocks that have raised their dividends 25 straight years, these stocks have raised their dividends for between 5 and 9 consecutive years. So they're called contenders, becoming challengers and ultimately aristocrats. So these are what we call the Young Aristocrats. We sort them by new highs, payout ratio. My fundamental friends tell me how important that is. I'll take their word for it. Goldman Sachs, baby, raised their dividends 9 straight years, paying almost 2%, breaking out of a 13-year base to new all-time highs. What's there not to like? If we're above 250, I like Goldman Sachs long, collecting that dividend, baby, with a target near 375. So, by the way, if you want these slides, don't forget info@allstarcharts.com, password universe. I want to take this opportunity to answer a couple of questions. So, we've got a few minutes. So, we have 3 questions today. First one comes from Timmy. Regarding the first 5 days indicator, JC, it's a bullish sign, right? It is. It's a bullish sign, right? Remember, this is a weight of the evidence approach. So what's he referring to for you guys wondering? So there's the Santa Claus rally, which are the last 5 days of the trading days of the year and the first 2 of the following year. So it's a 7-day period. And the S&P 500 was up during that 7-day period. It began on the way the calendar worked out on December the 24th, and went through January the 5th. And the Santa Claus rally was up 0.99% for the S&P 500. So call it 1%. Santa Claus showed up as he should have. Those are the most bullish 7 days of the entire year. They went up like normal. So there's no signal there. It's just great. Stocks are in an uptrend. We knew that already. Great. Not that there's anything wrong with that. It's not like a bearish signal. It's just, okay, go back and keep doing what you were doing before. So now next we have the first 5 days indicator, which are the first 5 trading days of the year, which this year was January the 4th through the 8th. And as those 5 days go, so goes the rest of the year, right? The old saying for a Santa Claus rally is, if Santa should fail to show, right? What does it say? If Santa doesn't show, if Santa fails to call, the bears will come to Broad and Wall. That's what they say. In other words, if there's no Santa Claus rally, that's normally, historically, an indication it's going to be a weak year. And it's been very consistent. Same thing with the first 5 days. If the first five days aren't up, that's a nice indication as well. Well, the first 5 days were up 1.8%, even better than the Santa Claus rally. So again, no signal there, just normal. We're in an uptrend. We already knew that. So I hope that makes sense. So there's one more of the trifecta, the January barometer. As January goes, so goes the rest of the year. That's the third of the trifecta. So far, January's up, but we're not even halfway there yet. So let's not call it too early, but a trifecta would be bullish for sure. Target on the S&P 500. It's a good question. For me, it's been 4,000. I mean, I'm most likely, based on the weight of the evidence, we're probably gonna have to raise that towards 4,500. But 4,000 has been our targets for a while. Those are the Fibonacci extensions from the 2000 and 2007 peaks. So that's been our target for a long time. And we're getting there. We're about 150 points away. So we'll probably update that somewhere closer to 4,500. We'll do some math on some of the components and come up with that. But, for me, it's more of, what are stocks doing than individual levels on the indexes? For me, that's a lesson I learned the hard way, folks. Focusing too much on this level or that level. Focusing on the components. What are stocks doing? Are more of them going up? Are more of them going down? What's breadth look like is more important than levels themselves. So I hope that makes sense. How do you avoid? Okay, so the question comes: how do you avoid the noise but still stay informed? So I put out a note. I don't know if you guys caught that. How 2020 was a noisy year. That noise was poison. If you were listening to the news instead of price, you got in trouble. You guys, I don't need to tell you guys. I mean, the news and the stock market didn't jive. So thank God we ignored the news and we follow price. If you want to stay quote unquote informed, for me, just make sure you curate a Twitter stream from people who add value, from people who that if there's something you need to know about, they're either going to be writing about it or they're going to be joking about it and making fun of it. For me, it's, stock market guys, trading guys. I want to know unusually large moves, and I want to know about Miami Hurricanes recruiting classes. Like, for me, that's the breaking news. So curate your own, stay away from the rest of the noise, and I'll put it up one more time just so you can see. So once again, guys, my name is JC Parets. I'm the founder of allstarcharts.com. I really appreciate you sticking with me. Boom, 29 minutes on the dot. How about that, StockCharts TV? Listen, guys, I really appreciate, shout out StockCharts, David Keller, and the whole gang over there. If you have any questions, email me. If you want the slides, info@allstarcharts.com. Password universe. Thanks, folks.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.